From the analysis of over 200 dividend stocks, we have selected 3 for this video, which we believe are good dividend stocks for the long term as natural dividend investors. Now, this selection is something we do on a daily basis. I am a long-term investor myself. I've been investing for over 10 years. With our company, Happy Invest, we help people with simple investing for financial freedom. And through YouTube, I help you with free content, hopefully from 0 to 100,000 euro. Who knows? And as a thank you, maybe if we help you well, you can always become a member of our club, our community. We also offer an analysis of dividend stocks, where we select one dividend stock every month, selecting why we think it's a good long-term investment. So just a good, strong company with interesting price potential for dividends. And yes, we actually analyze a lot of stocks daily, analyzing a lot of screening too. And we use a mix of data sets and data tools, also, of course, supplemented with our own insights from what we are good at, selecting good companies, but through YouTube. So mainly content for inspiration, because we want to share a lot of tips. That's, of course, for further research where we think they are the best. So we want it to do that through another channel. But I am convinced that you definitely find these stocks interesting. Be careful, critical too. Take a good look at the company and what is your investment worth, especially if you already have a full portfolio. Should you be critical of the opportunity costs? Can you find better dividend stocks? And who are you going to bet the farm on? Yes or no? That's, of course, the crucial question to achieve the highest possible return with a limited amount of money that we have. And sometimes, unfortunately, also time. My name is Jorgen van Meulen. As I already said, entrepreneur, investor, and do you find our videos valuable? It has helped you with our videos. I would like to do a small favor and subscribe, because 30% do not subscribe to our videos. Imagine doing a lot more, including you, who also gives a like to our video. That helps the channel. You have to grow versions, and the bigger our channel is, the more it yields, the more time and energy we can invest, also in better quality videos, but also data tools and databases, everything to help us achieve a bit of financial freedom, and of course, enjoy life, because that's the most important thing. But now let's move on to these 3, also very great ones that we are looking at for the long term.
An interesting dividend stock for the long term, which has recently dropped quite a bit in price, is Portland General Electric. I'll show you some characteristics of this stock to explain why it's interesting for dividend investors. First of all, it's an energy company, not much exciting to report about it. What's perhaps more interesting is the valuation, which doesn't seem very cheap, but still cheap enough, maybe for long-term dividend investors. Morningstar gives it a 4-star rating with an economic moat that doesn't really stand out. So it's not a very broad economic competitive advantage, but at least according to them, it's a small competitive one. Advantage, of course, that has to do with all the assets and the distribution network they already have for electricity. What's more interesting is their intrinsic valuation, which comes out to $53, and the current price has comfortably dropped to $40. So here is possibly a bit of margin of safety, but of course we need to calculate the intrinsic value ourselves. Absolutely. To ask, the advantage is that these kinds of companies are easier to analyze, making it easier to determine their intrinsic value. Analysts indicate that their price target is $51. That's also higher than the current price. Perhaps that's more interesting. The latest estimate is $43. So the price has dropped below that for some reason. The entire stock market is currently declining, so that could mean an interesting entry point for certain stocks that are already undervalued and are just getting cheaper, or even undervalued. Portland General Electric might also be undervalued. A tool we can use for that is fast graphs. We see that the current price to earnings ratio has now dropped to just under 13. Let's zoom in a bit more, and then we'll see that the current price is below the fair value line, which is the orange line. So this is actually the first time in quite a while that it has been like this. For long-term investors, this could mean an interesting moment, especially because it pays a relatively high dividend. And that's, of course, also the case for this analysis. Now, the current price to earnings or forward price to earnings has dropped below 13. Actually, the normal multiple is around 20. That does stop at the slightly higher end. Later, just to be safe, let's maintain a lower price to earnings ratio. Price, Wentz ratio. Then we see the possible liquidity figures below, forecasted by 11 and 7 analysts. Yes, around 4.5% and 2.5%. Profit growth isn't really that much. So that all seems quite realistic. That would also imply a lower valuation. Let's say it's 14, then the annual return could average around 11% for the coming years, with a total return of 70%. Keep in mind, this includes dividends. We're taking a slightly higher price to earnings ratio, and this is of course just a forecasting tool. Of course, reality could turn out to be disappointing, but then the return could actually be really attractively high on average, with even a 20% return, and the downside potential is always there. But it's of course just an established company with energy consumption from customers. It's an energy company. Yes, I believe energy will still be needed in the future. So you can think about it very difficult, but I think the current stock market is declining. I think this creates a buy moment, an opportunity to buy this stock. The valuation looks relatively good, at least because that's comparable to the sector median. But also, if we just look at the current figures, so the forward price to earnings for next year is set at around 13, not super cheap, but it's also not exactly too expensive. The payout ratio, that's obviously more important for the future. That's at 1.5. And ideally, we actually want a payout ratio below 1 or well below 1. So it's quite heavy in comparison. The sector or median is positive, but I wouldn't say it's super positive. The dividend yield is 4.8%. We'll take a closer look at that in just a moment. Well, what's attractive is the price to cash flow, which is relatively low. But be careful, this is a capital intensive company. So you'll want to look at the cash flow analysis here, for example, regarding what Freedom is. Cash flow that's operating cash flow minus capex or capital expenditures. That actually gives the free cash flow of the company. Very important. With this stock, before I start looking into General Electric, is the relatively high debt. The market value is 4.2 billion, but the total debt is 4.7 billion. So that's still quite on the high side. If you look at the price to sales, it's 1.2. So what you can do is always take the market value, turn the price to sales factor to 1.2, and then you know what the revenue is approximately. So in relation to the revenue, they have a lot of debt. So here you definitely need to take a good look at the balance sheet and the cash flow. What's exactly going on? Revenue growth and especially the profit growth have already been looked at for the earnings per share. Here we see some estimates, basic statistics for the EBIT growth, and regarding growth, it's relatively good compared to the sector. Actually, they only score on profitability. Compared to the sector, it's a bit less good, but the net income margin is still 10%. So a 10% profit margin isn't superior, but it's just fine. The mini sector is actually a bit higher, and this is compared to the electric utilities sector. So that's a good sector for them to be in. Compared, return on equity isn't special, but it's also not really a good stock. Overall, it scores relatively well on the factor analysis at the moment. Let's take a look at the dividend yields. Well, that's exceptionally high. The current dividend yield is 4.8%, especially because the current price has dropped quite a bit. The average over 4 years was around 3.8%, and for next year, a dividend of almost 5% is estimated. What's even more interesting is it has paid out dividends for 18 years in a row, and also 18 years in a row. Dividend growth. Well, that's certainly interesting. If you're a dividend investor looking to create more dividend on dividend, then Portland General Electric is a very interesting dividend stock, not just for dividends, but also for potential price appreciation. Stock, not just for dividends, but also for potential price appreciation, because the price has dropped significantly by about 16%. I've shown you the fair value estimate from Morningstar, which is around 53. And from analysts, it's around 51. Here you see the price was around 48 last September 2024, somewhat in line with 2023. But it has recently dropped by about 60% to a previous support level, you could say, based on technical analysis. As you know, I'm a long-term investor, but occasionally, here we are indeed looking at technical analysis to see if there is, for example, a support level. You could say you want to, but there are simply technical traders in our market, and they are already playing the game through me. So in the very short term, it's always useful to take a look at the technical charts. We've already noted that Portland General Electric seems relatively cheap in terms of its stock. Now you need to investigate what the future long-term growth potential of this company is. So mainly the competitive advantage. And if both of those factors are good, then the last thing is, of course, the right entry moment. We're actually looking at 2015, the same price level, and also the same price level in 2018. It only dropped further during the coronavirus crisis. So all in all, simply put, this could be an interesting entry point around $40. It seems that A&L is relatively cheap, or at least attractively undervalued. Not much margin of safety, for that A&L would need to drop further, and perhaps that's the case as well.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
Ingredion could be an interesting dividend stock for 2025 with an attractive dividend. Well, a potential price return and a price treatment that you might be able to benefit from. Ingredion is a company primarily active in ingredients, so they have a number of ingredients by type, but you can also find all the other things on their website. I have a background myself. I also have work experience in starches pepmol, so I do have some understanding of this market. But basically, Ingredion, the food industry, is sustainable for the long term, always needed, of course, for food. So the population growth is also relevant for that. And right now, it seems like Ingredion is available for purchase around its fair value. In any case, the intrinsic value calculation from Morningstar is 132, or the current stock price is 130, a star rating with limited option for advantage. So the economic moat is referred to as narrow. That's definitely more than nothing, according to Morningstar. And of course, they have a competitive advantage as a company. And the food industry that is not really very susceptible to intense disruptive innovation, but you never know. So valuing these kinds of companies is relatively easier. Now, analysts indicate that their price target in the short term is actually higher, 165, due to the current price of better is. It means an upside potential of 26%. More interesting, maybe the lowest target is just 147. If we look at the historical valuation of this company and this stock, then we see that for a period of lower prices, the stock price has been rising significantly for a while now. Now we selected it as a dividend stock sometime in 2023. Back then, it was still a lot lower. But now it could be interesting again because, as you can see, the current price is starting to drop again. And that's just it. We're asking how far this decline will continue, but that could become interesting. So at this moment, it seems that we can buy the company or the stock just below its fair value, just below the intrinsic value. But of course, you also want to have a margin of safety. So a bit of patience waiting for the price to drop further could be quite interesting. Why, we'll get into that more shortly. So the price to earnings ratio has dropped to around 12. But the normal multiple for the price to earnings ratio is at 13. In the past, it was a bit higher, but let's stick with 13. Below, we see the analyst's estimate regarding EPS growth. That doesn't look excessively high. Only 6 and 4% growth for head earnings per share is not extremely high. So a multiple of 13 seems to be in line with everything. Well, then the potential return could be, on average, almost 12%, including a return of about 2.5%. Sounds realistic, but it could also be that it's a lower multiple. At 10, there is no cow yield. And the EPS estimate can, of course, also go wrong, but it could also be a bit higher. Now, why is the ingredient possibly still interesting for both the short and long term? The factor analysis indicates that it's a strong buy. We can see that here. This is an algorithm that I personally have had a positive experience with. And by the way, this is seeking alpha discount link. We are offering in our description. So check our YouTube description and you'll find a discount link. Can you also try this program yourself? They let you try it for 7 days. And when we look at the valuation, it looks relatively good compared to the sector. Well, it's also interesting to see that here you see the price to earnings ratio for next year estimated to be around 12. And the 5-year average of Ingredion is a bit higher in that regard, namely so even compared to its own valuation, it does seem a bit cheaper than usual. Price to earnings of 12. For this type of company, Midge Easy is okay, but it can always be cheaper. Maybe it will drop below 10, and that might be possible with the current price drop because the stock market is also starting to decline, so that could really present an interesting opportunity. The PIC ratio is a bit higher than we would like to see. We actually prefer to see that under 1. On the other hand, the price to cash flow seems to be okay. There are really a lot of specifics regarding the debts. The debt level is not very low. But they also have significant cash, so in the short term, there seems to be liquidity for solvency. And for the long term, of course, the Monday research is needed to quickly check the balance sheet to see how that development is going and how they are using those debts. Now, regarding growth, that's not very remarkable. Indeed, the email growth for next year is estimated at 11%. If we look at the estimate of EPS growth for the next 3 to 5 years, it's 11%, and that's a bit on the higher side, but we've already seen what the PIC ratio is, namely 1.3. The PIC ratio takes into account the EPS growth for the coming years. The operating cash flow growth is quite impressive, 90%. The dividend growth for this year was 8%, but let's take a closer look at that in a moment. First, the profit margin, quickly, 9% profit margin. That's not great, but it's just average. And it does mention sector median here, but there are also quite a few other types of companies in this sector. I've already told you, I have experience in this market, the food industry, and a 10% profit margin is kind of the target that most companies want to achieve. So that's just in line with the industry. Return on equity is quite high at the moment. The 5-year average return on equity isn't too bad either. It's still a little surprising. Return on total home capital, 10%. The 5-year average is at 8%. As a pre-investor, you would obviously want to see higher performance. So I'm not going myself either. Investing in ingredients. As far as I'm concerned, there's just a bit too little good potential as a company. Also not unique enough, by the way. And yes, also in terms of profitability. It's not that it's a super high profit margin, and it's also not significantly higher than the sector median. And of course, if it achieves higher profits than its competitors in the very long term, then it will outperform. That's why quality investing, in other words, high quality stocks, you often recognize them by the combination of high profitability and an increase in high return on equity and return on invested capital. We're really talking about this. Dividend stocks. Companies that consistently pay dividends are, of course, more in the maturity phase, so a bit less growth, and that makes sense, of course. And that's why we assess these types of stocks based on different characteristics, and specifically whether the valuation, at least the current valuation, is okay, not too high. For Giri, that seems to be the case. The 4-year average dividend is 2.7%. For the rest, the estimate for next year is 2.4%. What is disappointing about this dividend stock is that it doesn't achieve much dividend growth year over year. It's actually been interrupted, but what they do is pay dividends for 20 years in a row. Just a little longer, another 5 years, and then they are a dividend aristocrat. Do they belong to a nice list of dividends? Aristocrats. At Albadol, the dividend growth is not super, so not really a dividend growth stock, but they are doing relatively well. That benchmark yield isn't super high either. 2%. Albadol seems to be doing reasonably well here. Well, when I'm not on the very high side, and that's a bit of it, due to the recent price drop, over the past few months, the stock has fallen by 13%. That's quite significant, you would think. I think it might drop a bit further, because the entire stock market is currently declining. What would be really interesting is if the stock drops to around this level of 110. That sounds very low, but a smart investor often takes that. Still, time is on your side, and maybe you'll get lucky. That actually means a decline of 26% compared to the last peak, or another drop of about 10 to 15%. And for the long term, you can see that there is generally some growth, but also some phases with quite significant declines. So the volatility, which you would expect for a dividend stock, isn't there. But here you see a 50% drop, of course, during the financial crisis. However, here in 2011, there wasn't really anything special. The stock has fallen by 35%. So that's probably based on quarterly figures. You also see a very rapid decline, by the way. It does drop here and there by 20% or more. And, of course, 2018 comes along with, for example, 2020. So, yeah. a bad negative trend, also combined with a crash in the stock market, has led to a 53% drop. Well, I think that's quite a lot for the current situation, but never say never. So I would be patient here and wait until it either drops to this level, either the price level of 110 or maybe even further down to the price level of, for example, 100. But all in all, Ingredion seems to have a good chance of success with an attractive share price potential. And these estimates can always change from time to time. That's the downside to these estimates. So the best thing you can do is to do your own research on the company and its competitive position. Do you want to know what we consider the best dividend stock? Do you select every month? Then take a look at our website. Happy Investors for Dutch or international is businessinvestors.info. And what you get then is a 30-day trial period. Try it out. And with HappyVest, it's a 14-day trial for €1. Every month, a dividend stock that we believe has potential for the long term. That's a monthly overview of top dividend stocks. And of course, you can also choose other chains for the bundle discount, but that's not what you're here for. All in all, I think Ingredion is interesting as a dividend stock for the long term, but I would be patient here for a moment. And possibly with the help of MR Market, then the price will drop further, and we can buy ingredients at a better price with a margin of safety.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
An interesting dividend stock to watch in 2025 is Philip Morris. Philip Morris is certainly well known in the industry it operates in, namely tobacco. Not really loved by most investors. It also doesn't meet the ESG criteria and probably doesn't meet many ethical standards. And that's why these kinds of companies are often undervalued when things are going badly. Well, Philip Morris is actually not one of those cases. It seems to be a bit overvalued. Still, it could become an interesting dividend stock. They are what can surprise us. And in this analysis, I will explain why. Now, the current share price is 117. According to Morningstar, the intrinsic value calculation is $120. And that's why it gets 3 stars. 3 stars, why? Because they indicate that it has a formidable, strong competitive advantage, or an economic moat. Now, the moat trend is actually negative. That's interesting. We don't see that very often. That basically means a company that is that's quite something, isn't it? There is a declining trend regarding the fundamental developments of their strategic position. So that's quite remarkable. However, I live in the Netherlands. Philip Morris also has many facilities in the Netherlands. I live close to one of those facilities, and I know that a lot is being invested there. But the company also makes a lot of profit. It really has enormous cash flow. So I wouldn't just write off the strategic developments for the long term. But of course, the industry it operates in is not for everyone. By the way, I don't invest in it myself either. Philip Morris, it's not a stock that interests me as a growth investor. But as a dividend investor, it can be interesting. Now, the current price target is 136 according to Wall Street analysts. And that's actually it. Investors from Wall Street expect that this stock can outperform and actually increase in the short term. If we really look at the historical valuation, we see that Philip Morris currently seems to be slightly overvalued. If we zoom in on a more current time frame, then the difference between the intrinsic values is even smaller. So the difference isn't very big, but then there is no margin of safety anymore. And soon a bit more about how you might benefit from that, or I should say be able to handle it. The price for Eurus right now is around 18. Then it's slightly above normal multiple, because the normal multiple is around 16. And actually for the very long term, as you can see, even at this price level, the estimates from analysts are still quite positive with an EPS growth of an average of 10%. That's not very unrealistic for this type of company, but it might be a surprise for you. If you look at the normal multiple of 15.9, and let's say the EPS growth is realized, well, it's never exact according to these forecasts, but let's say that's a bit average in line. Then in 3 years from now, you could achieve a 35% return if you jump in now. And that could mean an average return of almost 11%, including dividends. If you look at the S&P 500, which has a price to earnings ratio of over 25, then Philip Morris has a low earnings multiple, and also an EPS growth of possibly 10% per year isn't even that unattractive. Looking at the factor analysis, Philip Morris scores high on the quality rating, even a strong buy, but valuation and growth are not yet super attractive. Well, it has a very high profit, and the momentum is okay, and the revisions are positive. That means the analysis expects the company to make more profit than initially projected. The current price to earnings ratio is therefore around 17 to 18. Initially projected, the current price to earnings ratio is therefore around 17, 18. The luck ratio is currently really below 1, but next year it's estimated to be above 1. The price to cash flow is 17, which we just saw with 4.5%. Overall, everything seems not cheap at the moment and possibly even slightly overvalued. I'll talk more about how you might deal with it shortly. The revenue and profit growth are pretty decent, and what we really want to focus on is the EPS growth for the longer term. 3 to 5 years, well, that's also estimated here at 10%, so that aligns with the databases. Look, and that profitability is of course super high, 26% profit margin, even with an EBITDA margin of 40%, and the 5-year average is also around the same level. So it's not that it usually has spikes upwards. No, Philip Morris generates standard high profits. I already mentioned it, the company generates a lot of cash flow. Yes, it is a capital intensive company, which is a downside. At least it depends on how you look at it. So they have relatively higher CAPEX. But if you generate a lot of cash, then you can also invest a lot of cash. That maternal total capital is surprisingly high. I think so, 20%, and even the 5-year average was 31%. Quite remarkable figures for this type of company like Philip Morris, or also British Tobacco with the ticker BTI. An analysis that we previously shared on our channel, that's also a high dividend stock with more than 6% dividend per year. That can sometimes surprise you. And BTI is indeed doing very well. So you want more shares, analysis, ideas, then of course follow us on YouTube. I think it's going to bring a lot of enjoyment, even if it's just for inspiration after the research, because we actually analyze thousands of stocks weekly in various screeners, and we do it for ourselves, but also for our members. Deep dives into certain companies to see if they are good long-term investments, but we don't know the fourth morning inside out. So this is also a screen stock. So this is more for inspiration. Everything looks okay. The dividend yield is 5% of the 4-year average. At the moment, it's 4.5%, and we expect it to rise slightly to 4.6%. Looking at the dividend consistency, Willebroeks is very interesting for dividend investors. Even though the stock, let's say the company, might raise doubts about its viability given the industry, but the company continues to perform against expectations, so that's really good. The dividend history is ample, as you could say, with 16 years of dividend growth, and also 16 years of consecutive dividend payments, but especially 16 years of consecutive dividend growth is really very strong. The Philip Morris, whatever you think about it from emotion, if you purely look at the facts, the statistics and data, then it's just a great growth stock when it comes to dividends. I have to say, a dividend growth stock, at the moment the price is fluctuating, so minus 12%, and even now it's still not a super attractive buying level, as I mentioned. So what would be interesting at this moment, specifically at this moment, in 2025 the stock market is declining. That's positive. Why? Because ultimately many stocks will continue to decline because of that. So Philip Morris might drop to a price level of around 100. That means another drop of 11% compared to the current level. And actually, compared to the previous level, minus 20%. The stock might stabilize at the price level of 100. Then we actually get a more realistic instant moment. Then the price is a bit around the price earnings of 15. Then it comes back to the intrinsic value. It could be that if a real kind of bear market comes, the stock will drop further, maybe down to 90 or but below. But I don't see that happening very quickly, that it will drop a lot further. Imagine you're lucky and patient, and you can buy Philip Morris at a price level of 90, and the EPS. In estimates and your own forecast, you still said that the company is going to make 10% store profit per year. Well, then it seems to me like a very good one, dividend stock. But personally, I wouldn't jump in at this moment. I would wait for the current developments in the stock market, because everything is starting to decline now. And also this rate here could possibly continue. You never know exactly until when. So actually what's more important is investing in high quality companies. How do you recognize that? Well, Philip Morris has, for example, a very high profitability. That's one of the criteria. Other criteria It has a large market growth. The company has innovative developments to sell new products, to stimulate further profit growth, and does it, for example, have very strong management? You need to determine all those kinds of categories for yourself. So do thorough research on Philip Morris. For me, it's not a buy. It doesn't fit in my portfolio either. I am a growth investor, but all in all, those are personal choices. I hope you found this analysis interesting enough. Do you want more deep dives? Then take a look at our website, happyinvestors.nl, for Dutch, or businessinvestors.info for international. Then you'll find dividend analyses. 1. Dividend. Stock per month, really a deep dive, and a monthly update on dividends. Stocks. That's about our company. Good morning. There is upside potential, but maybe for the short term, just wait until the price has dropped further. Then you're in luck. Can you buy with a bit more margin of safety around the intrinsic value, or maybe even below it? And in the meantime, just 5% dividend per year collecting. Thank you for watching, and see you next time.